The debate around using passive versus active strategies in an investor's portfolio continues to rage on following research performed by Itransact, which found that less than 50% of active funds are able to beat market indexes on the JSE. The case for using passive strategies for a large proportion of investors' exposure has been made all the stronger now. Philip Bradford, head of investment philosophy and strategy at Absa Wealth, joins us at the desk to debate even further. Thank you so much for joining us today, Philip. So when it comes to the debate right now in South Africa, what is your thinking when it comes to the role that active versus perhaps passive indices play in a portfolio?
Well, I like to think of myself as quite objective in this debate as well, because I actually invest for our clients using both active and passive. But importantly though, whenever I hear a study like that tells me that on average, the average fund manager performed average, all it tells me really is that costs are very, very important. So you're 100% certain that costs will reduce your performance. And I think that's really what's coming out of it, is that if active investing is very expensive and it's not necessarily adding value, then you've got to ask some serious questions. From my perspective, I tend to buy active managers or employ them to use in clients' portfolios at a similar price that I often pay for a passive type portfolio. So for me, it becomes more around what risk am I taking? And in a typical index type scenario, we're very clear about the risks. We know historically how an index has performed, but we also know that an index tends to be overweight your largest capitalization stocks, which tend to be growth stocks or stocks that have done very well. So we know from history, if you look back at other studies, that actually the strategies that have tended to perform well are often strategies that are equal weighted. In other words, they're not you don't want to go more overweight BAT, Anglos or Billiton than the index, otherwise you're often taking too much risk. But we also know that small caps over time can do quite well as they become bigger and bigger in the index. So you need to look at what kind of a risks you're taking, I think, if you deviate from an index. So as an example, value investing. You mentioned it a moment ago that value is the flavor, but we know now that value, if you look at South African managers over the last while, have significantly underperformed, especially your deep value managers have underperformed the index over the last year or two in particular. They tend to do very well when markets are not doing very well, but when markets run very hard, the value managers will tend to hang behind. But when you're investing as a value investor, you're actually buying more risk. So you pay up for a value premium. And because a stock is cheap, there's a reason it's cheap. It's not cheap simply because the market's forgotten about it. Normally they've gone through a difficult patch from a company perspective, and it's priced in that kind of risk. So you're taking more risk by being a value investor, but you're typically well rewarded for it.
Philip, just in terms of the nuts and bolts, and I look at this analysis all the time. We look at how many funds outperform a market index like the All Share or the Top 40 index. Yes, there is a fair amount that do. How consistently and over what periods is quite a different story. The question I want to ask you is, is all the time and effort you try and do to try and uncover these fund managers worth the result in terms of outperformance of the index?
Let me answer the question this way. If you're going to build an investment portfolio, the most important decision is asset allocation. So how much to expose to equities, bonds, cash, property, local and global. History shows us, if you look through any of the studies, anywhere between 75 to 105% of performance actually comes from that decision. So I spend more than 95% of my time worrying about asset allocation and getting that right.
And the risk attached to those various asset classes.
Correct. And then once you've got that decision in place, or on yourself being an athlete, if you're running a race, if you're running the comrades, asset allocation is like the kind of training you're going to do. Stock selection for me is a bit like the brand of running shoes you may choose. It might make a bit of a difference, but it's unlikely to be the main determinant of your success. So once you've made your asset allocation decision, you've now got to work out how much you're going to allocate to equities and how you're going to do that. And that's when I would start looking at passive and active and potentially combining the two as well. And what I would look for in an active manager is someone who's not necessarily going to outperform the market for me, but is actually going to give me a risk control. So what I find, if I compare a passive portfolio that we've managed on an asset allocation basis versus a more active portfolio, the active portfolio, particularly when we employ asset allocation managers, they tend to be underweight certain things like property. That's what's really hurt them. They'll do okay, and they haven't exposed themselves as much to bonds. But on the passive side, what I pick up is a lot more volatility or risk, as it tends to be called in a more of an investment management sense. So over time, particularly since we've been running portfolios over the last 4 years, our passive portfolios have actually done marginally better. but they've actually taken more risk to get there. So what I find from an active manager is they often give me a more comfort in terms of the types of stocks they're picking. However, though, remember for me, because I'm not sure how they're going to perform, they're adding a different kind of risk to me. They're adding a stock selection and underperformance risk. So I need to look at all of those things. And that's why I find the active-passive debate is not a clear one. Passive in itself is not index investing. There's a lot of passive investors out there that are simply buying, that have got an algorithm in place. A lot of the ETFs are active ETFs.
I was going to say, what about smart indices, a bit of a hybrid between the two?
I think that's probably your best bet when you're looking at something like that.
Are you using smart indexes at the moment?
We're struggling to find a lot of them that are doing exactly what we'd want them to do, and they're not always as investable as we'd like them to be as well. So typically, I find a lot of the smart indices are still driven by a human behind the scenes. They decide what goes into the algorithm. They decide on the maths. They might not pull the trigger at the end of the day,
right?
But there is still a potential for human error. So you've got to make sure does that black box actually work better? And very often the market can actually give us that kind of return. Also, you tend to pay up for those sort of products. So just because it's an ETF doesn't necessarily make it cheap. And sometimes actually I'll pay less for an active manager than I will for an ETF. And I would say for the average investor, the small investor, someone who's investing, let's say 10,000 Rand, a unit trust can actually be very, very cheap, because you don't pay brokerage and so forth if you do it yourself. Where an ETF, I think, is a great vehicle for an institutional type investor. So as a great example at the moment, we're very, very positive on developed market equities, particularly the US and Europe. Now, we either go and find, how do we go and invest in that for our clients? We either find an active manager that has a great skill in those specific areas, but it's unlikely because they're such big markets. So we'll often have a quants filter where we will decide, these are the types of stocks we're looking for. This is the profile of stocks we're looking for, and we'll try and get our clients to enter that market through that kind of route. So a theme is something where you can really use an ETF very, very well, and you can get in and out very easily. An active manager, often they'll do whatever they want. So they might invest in the US, they might not, they might be in Asia, they might be investing in South African stocks.
But pretty much what you're saying, there's a place for both in a portfolio. But thank you so much for joining us today. Good to have you on the show again. Philip Bradford, Head of Investment Philosophy and Strategy at Absa Wealth.